This presentation extends our survey of capital markets research in accounting by examining 3 additional foundational streams. 1. Disclosure research, which investigates the causes and consequences of corporate information provision. 2. Cost of capital research, which examines how accounting information quality affects the risk premiums demanded by investors. And 3. Market efficiency research, which assesses how quickly and accurately prices incorporate accounting information. These 3 streams complement the earlier survey's coverage of capital market research, value relevance, and earnings management by providing deeper analysis of the mechanisms through which accounting information enters and affects capital markets. Understanding these streams is essential for doctoral students because they address the fundamental infrastructure of capital markets. Why firms disclose information, how that information affects the price of capital, and whether markets process this information efficiently. These questions lie at the heart of accounting's role in the economy and directly inform both regulatory policy and firm-level financial reporting decisions. Today's discussion maps the information lifecycle in capital markets. We explore 3 core questions. Disclosure research asks why and how firms release information. Cost of capital research examines the economic benefits of that disclosure. And market efficiency research considers whether market behavior aligns with theoretical predictions. Notice how these topics interconnect, influencing investor decisions. We will examine each research stream in detail to understand their vital roles in financial markets for deeper insight. Let's begin with Part 1 on disclosure research. This segment examines determinants and consequences of firm disclosure. It covers mandatory filings like SEC reports and GAAP statements, as well as voluntary information such as forecasts, press releases, and ESG communications. Disclosure is far from a mere formality. It is a strategic mechanism that shapes investor perceptions and market behavior, with critical academic insight. In disclosure research, we delve into the theory of information asymmetry. Akerlof's-Lemon's paper illustrated how private information can lead to adverse market selection, where investors devalue all firms. Verrecchia's threshold model further explains that managers selectively disclose to signal good news. Meanwhile, the unfolding argument by Grossman, Hart, and Milgrom proposes that full disclosure is ideal, but never fully materializes due to cost and risk factors that complicate market interactions in practice. Diamond and Verrecchia's 1991 study bridges disclosure and cost of capital theories. Their work reveals that increased disclosure reduces information asymmetry, boosting stock liquidity. Enhanced liquidity in turn lowers the firm's cost of equity, since with more transparent information, investors demand a smaller risk premium. Subsequent research by Healy, Pulapu, and Botosin further substantiated this link, setting the stage for a rich empirical literature that continues to influence modern financial reporting practices decisively. Disclosure research asks 4 core questions. 1. Why do firms disclose? What determines the level and quality of voluntary disclosure? Research examines the roles of capital market incentives, reducing cost of capital, attracting analysts, product market competition, proprietary costs, litigation risk, managerial incentives, and corporate governance. 2. What are the consequences of disclosure? How does disclosure affect information asymmetry, trading volume, analyst following, bid-ask spreads, stock liquidity, and the cost of capital? Does more disclosure reduce information risk for investors? 3. Does mandatory disclosure matter? Do regulatory requirements such as Regulation FD, 2000, SOX, 2002, and IFRS adoption improve the information environment? Can mandatory disclosure substitute for or complement voluntary disclosure? 4. What is the role of disclosure channels? How do different channels, annual reports, management forecasts, conference calls, social media, ESG reports, vary in credibility, reach, and market impact? Key methodologies. Disclosure indices. Construct composite measures of disclosure quality from annual reports, e.g., AIMR ratings, self-constructed indices, and test associations with firm characteristics and capital market outcomes. Management forecast studies. Examine the incidence, precision, accuracy, and market reaction to voluntary earnings forecasts as a direct measure of voluntary disclosure. Textual analysis. Apply NLP and machine learning to 10K filings, MD&A sections, and conference call transcripts to measure disclosure attributes such as readability, fog index, tone, specificity, and similarity across periods. Natural experiments. Exploit regulatory changes, Reg FD, SOX Section 404, IFRS mandates, as exogenous shocks to the disclosure environment, enabling causal inference about disclosure consequences. Before moving on, let's consider some open research puzzles. The credibility puzzle. Voluntary disclosures are only valuable if credible, yet managers have incentives to be strategically optimistic. How do investors assess credibility in real time? And what makes some firms' voluntary disclosures more believable than others? The role of reputation, verification mechanisms, and commitment devices remains incompletely understood. The proprietary cost black box. Theory predicts that firms withhold information to protect competitive advantages, but measuring proprietary costs directly has proved nearly impossible. Are proprietary costs as large as firms claim? Or are they often used as a pretext for opacity? The ESG disclosure paradox. Despite explosive growth in ESG reporting, there is little consensus on whether ESG disclosures are informative for investors or merely greenwashing. Without standardized metrics and third-party assurance, can ESG disclosures achieve the credibility of audited financial statements? Disclosure overload. If more disclosure is better, why do studies suggest that increasing disclosure complexity can actually reduce price efficiency? At what point does incremental information become noise that overwhelms investors' processing capacity? Causality in disclosure research. Most evidence on the benefits of disclosure is associational. Firms that disclose more tend to have better outcomes. But is this because disclosure is beneficial, or because high-quality firms self-select into greater disclosure? Despite clever identification strategies, the endogeneity problem remains the field's most persistent methodological challenge. Now we turn to Part 2 on cost of capital research. This segment investigates whether financial reporting quality impacts investor-required returns. Cost of capital research in accounting investigates whether and how the quality of financial reporting affects the rate of return that investors require to hold a firm's securities. The central proposition is that higher quality accounting information reduces uncertainty and information asymmetry, thereby lowering the risk premium embedded in the firm's cost of equity and cost of debt. This stream bridges accounting and asset pricing by asking whether accounting quality is a price risk factor in capital markets. The theoretical literature offers two primary channels through which accounting information quality affects cost of capital. The first operates through information asymmetry and liquidity. Diamond and Verrecchia, 1991, and Amihad and Mendelsohn, 1986, show that greater information asymmetry among investors leads to wider bid-ask spreads, reduced liquidity, and higher required returns. To the extent that better financial reporting reduces information asymmetry, it should lower the cost of capital through this liquidity channel. The second channel operates through estimation risk. Easley and O'Hara, 2004, argue that the precision of public information affects investors' portfolio choices and therefore asset prices. Investors demand higher returns to hold stocks with greater information risk, because less precise information increases uncertainty about future payoffs. Lambert, Luz, and Verrecchia, 2007, formalize this intuition within a CAPM framework, showing that accounting quality can affect cost of capital both by reducing assessed covariance with market returns and by improving the average precision of investors' information. A critical theoretical debate concerns whether information risk is diversifiable. If estimation risk can be eliminated through diversification, it should not be priced in equilibrium. Hughes, Liu, and Liu, 2007, show that asymmetric information can generate both a diversifiable component and a non-diversifiable systematic component that affects cost of capital even in large economies. Lambert, Luz, and Verrecchia, 2012, further clarify the conditions under which information effects on cost of capital survive in well-diversified portfolios. Examining the empirical evidence reveals promise and measurement challenges. Botosin's 1997 findings established a direct link between disclosure and a lower cost of equity for firms with low analyst following. Francis and colleagues, 2004, demonstrated that accrual quality matters for cost, while Hale and Luz, 2006, connected strong regulation to lower cost across 40 countries. However, implied cost models, as noted by Easton and Monahan, 2005, suffer from errors that complicate causal interpretations. There are some core research questions. 1. Does financial reporting quality affect cost of equity? Do firms with better disclosure, higher accrual quality, or more transparent reporting enjoy lower cost of equity capital? This is the central empirical question in the literature. 2. Is information risk priced? Is information quality a priced risk factor in asset returns, or can information risk be diversified away? The answer has profound implications for the economic consequences of accounting standards. 3. Does disclosure affect cost of debt? Do lenders reward borrowers who provide higher quality financial information with lower interest rates, fewer covenants, or better loan terms? 4. How do accounting standards affect cost of capital? Does mandatory adoption of IFRS, improved enforcement, or enhanced audit quality reduce the cost of capital at the country or firm level? Key methodologies. Implied cost of equity. ICC back out the expected rate of return from stock prices and analyst earnings forecasts using valuation models. GLS model. Easton 2004 PEG ratio. Olsen Jutner Noroth. This is the dominant approach in the literature. Realized returns. Use realized stock returns as a proxy for expected returns in cross-sectional asset pricing regressions. This approach is simpler but criticized because realized returns are a noisy proxy for expected returns. Bid-ask spreads and liquidity. Measure information asymmetry effects on the cost of capital through trading-based proxies such as bid-ask spreads, Omihud illiquidity measures, and PIN probability of informed trading. A loan-level analysis. For cost of debt studies, analyze loan spreads, bond yields, and credit ratings as functions of borrower reporting quality, controlling for other determinants of credit risk. The cost of capital literature faces several enduring puzzles. The measurement impasse. After 2 decades, there is still no consensus on how to reliably measure the expected cost of equity capital. Implied cost of equity estimates are sensitive to model specification and forecast inputs. If we cannot measure the dependent variable reliably, how confident can we be in any empirical conclusion about what affects it? Diversifiability of information risk. Theory offers competing predictions about whether information risk is systematic or diversifiable. If it is largely diversifiable, then the entire premise that accounting quality affects cost of capital through an information risk channel would be undermined. The empirical evidence remains mixed. The real effects question. If accounting quality reduces cost of capital, does this translate into real investment efficiency, more projects undertaken, better capital allocation, higher firm value? The chain from reporting quality to cost of capital to real decisions has many links, each measured with noise. Establishing the end-to-end causal chain remains a grand challenge. The ESG cost of capital puzzle. A rapidly growing literature claims ESG performance lowers cost of capital. But does ESG reduce fundamental risk? Or do ESG preferences create pricing effects that are not related to risk? Distinguishing between risk-based and preference-based explanations has significant implications for whether ESG mandates are economically efficient. The equilibrium puzzle. If better disclosure lowers cost of capital, why don't all firms maximally disclose? The theoretical models predict equilibrium levels of disclosure, but we observe enormous cross-sectional variation. Are the costs of disclosure, proprietary litigation processing, really large enough to explain observed withholding, or are there behavioral or organizational frictions at play? Transitioning to market efficiency, we enter a fiercely debated realm of financial economics. The core issue asks whether stock prices promptly reflect public accounting information. While the efficient markets hypothesis asserts immediate adjustment, persistent anomalies suggest otherwise. Accountants bring valuable insight since they comprehend underlying signals such as earnings and accruals. This debate challenges traditional views and motivates further inquiry into how market dynamics integrate accounting data. Market efficiency research in accounting examines whether and how quickly stock prices incorporate accounting information. The efficient markets hypothesis (EMH), articulated by Fama, 1970, in its weak, semi-strong, and strong forms, serves as both the theoretical foundation and the foil for this literature. Under semi-strong efficiency, stock prices should fully and immediately reflect all publicly available information, including the content of financial statements and other corporate disclosures. The accounting literature tests this prediction extensively, documenting both evidence of efficiency, rapid price responses to earnings announcements, and persistent anomalies, post-earnings announcement drift, accrual anomaly, that challenge it. Doctoral students should master 4 key perspectives on market efficiency. First, Fama's 1970 framework categorizes market efficiency into weak, semi-strong, and strong forms, though his own joint hypothesis problem remains. Second, Grossman and Stiglitz, 1980, showed perfect efficiency is impossible. Third, behavioral finance explains biases, while fourth, Schliefer and Vishny, 1997, reveal arbitrage limits that allow anomalies to persist. Fama, 1970, defined an efficient market as one in which prices fully reflect available information. This deceptively simple definition generated decades of research and debate. The joint hypothesis problem, recognized by Fama himself, is that any test of market efficiency is simultaneously a test of the asset pricing model used to define normal returns. If we observe abnormal returns following an accounting event, we cannot definitively determine whether markets are inefficient or our model of expected returns is misspecified. Grossman and Stiglitz, 1980, demonstrated that perfectly efficient markets are informationally impossible. If prices fully reflected all information, no investor would have incentive to spend resources acquiring and processing information. Some degree of inefficiency is necessary to compensate informed traders for their efforts. This insight implies that the relevant question is not whether markets are perfectly efficient, but how close to efficiency they operate, and what frictions prevent full price adjustment. Behavioral finance, drawing on Kahneman and Tversky's prospect theory and related work, offers alternative explanations for pricing anomalies. Investors may exhibit cognitive biases, overconfidence anchoring limited attention, representativeness, that cause systematic departures from rational pricing. 2 influential behavioral models formalize these intuitions. Barbaras, Schliefer, and Vishny, 1998, showed how conservatism, underweighting new evidence, and representativeness over extrapolating short patterns, can generate both underreaction and overreaction to information. Daniel, Hirschliefer, and Subramaniam, 1998, proposed that investor overconfidence about private information and biased self-attribution produce short-run momentum and long-run reversal, 2 of the most robust patterns in empirical finance. A critical complement to the behavioral perspective is the limits of arbitrage framework. Schliefer and Vishny, 1997, demonstrated that even if some investors are rational, their ability to correct mispricing is constrained by fundamental risk, noise trader risk, and implementation costs. This explains why anomalies can persist. If corrective trading is costly or risky, mispricings need not be eliminated. The finance literature has extensively documented that anomalies are stronger among stocks that are more difficult or costly to arbitrage: small, illiquid, and high idiosyncratic volatility stocks. The accounting literature documents several striking anomalies. Do prices respond efficiently to earnings announcements? The original Ball and Brown, 1968 question. While prices move rapidly at announcement, the persistence of PhD suggests that the response is incomplete. Do investors correctly process accrual information? Sloan, 1996, showed that investors fail to distinguish between the cash flow and accrual components of earnings, leading to mispricing, the accrual anomaly. This raises fundamental questions about the sophistication of market participants. What role do investor attention and processing costs play? Do limits to attention, Hirschliefer, Lim, and Teo 2009, cognitive complexity, and information processing costs explain observed pricing anomalies? This substream examines whether seemingly irrational behavior has rational information economic explanations. Are accounting-based anomalies disappearing? As anomalies are published and arbitrageurs trade on them, do they attenuate over time? Green, Hand and Zhang, 2017, and McLean and Pontiff, 2016, document that anomalies weaken after publication, raising questions about the persistence and economic significance of market inefficiency. This evidence underscores the role of accounting insights. Landmark finance research intersects with accounting anomalies. Jagadish and Titman's 1993 Momentum study revealed profits from buying winners and selling losers. DeBont and Thaler 1985 identified long-term reversal, where past losers outperform winners. Fama and French's factor models suggest that size and value premiums may compensate for systematic risk, challenging mispricing views. Finally, McLean and Pontiff, 2016, show that anomaly returns decline post-publication, indicating market learning. This evidence reshapes our understanding of pricing. Key methodologies used in this type research are: event studies, measure cumulative abnormal returns (CARs) around accounting information events to assess the speed and completeness of price adjustment. The methodology traces directly to Ball and Brown, 1968, and Fama et al. 1969. Calendar time portfolio sorts. Form portfolios based on accounting signals, accruals, earnings surprise, fundamental ratios, and track risk-adjusted returns over holding periods to identify mispricing. Cross-sectional return predictability. Regress future returns on accounting-based variables to identify anomalies, persistent predictive patterns that are inconsistent with market efficiency under standard risk models. A limits to arbitrage analysis. Examine whether anomalies are concentrated in stocks that are difficult or costly to arbitrage, small, illiquid, high short sale constraints, which would suggest that transaction costs prevent rational traders from correcting mispricing. Current market efficiency research explores several important frontiers. First, the rise of algorithmic and high-frequency trading raises questions about whether machine-processed information has made markets more efficient with respect to accounting information. Second, researchers examine how social media, Twitter/X, Reddit's Wall Street Bets, and retail investor trading affect the efficiency of price responses to accounting information. Third, the increasing availability of alternative data sources, satellite imagery, web scraping, credit card data, raises the question of whether traditional financial statements have lost their comparative advantage in reducing information asymmetry. Fourth, experimental and archival research on limited attention and cognitive processing constraints continues to refine our understanding of why anomalies persist. Finally, the international dimension. Whether market efficiency varies systematically with institutional characteristics such as investor sophistication, enforcement quality, and accounting standards, is an active area of investigation. Market efficiency presents deep puzzles. The joint hypothesis problem. Any test of market efficiency is simultaneously a test of the risk model. After 50+ years, we still cannot definitively distinguish mispricing from risk compensation. Is this a solvable problem? Or is it an inherent limitation that means market efficiency can never be conclusively tested? The Anomaly Zoo, Harvey, Liu and Zhu 2016, document over 300 factors that predict cross-sectional returns. Are these genuine anomalies, data mining artifacts, or compensation for risk? The proliferation of anomalies threatens to undermine the credibility of any individual finding. The persistence puzzle. Why do anomalies like PhD persist for decades after their discovery, even as arbitrage capital has increased? If markets are learning, why is the convergence so slow? Is there a floor to inefficiency set by fundamental limits to arbitrage? Algorithmic trading and efficiency. High-frequency trading has dramatically reduced the time to incorporate information into prices. But has this made markets more efficient in a meaningful sense? Or has it merely shifted inefficiency from short-horizon price responses to other dimensions, e.g., longer-horizon fundamental valuation? The retail investor resurgence. The GameStop episode, 2021, and the rise of commission-free trading demonstrated that retail investors can collectively move prices far from fundamentals. Does the growth of retail participation threaten the information efficiency that institutional investors provide, or is it a temporary phenomenon? These three research streams form a tightly integrated system. Disclosure research asks why and how firms release information. Cost of capital research asks what economic benefit this information provision confers. Market efficiency research asks whether the market actually uses the information as theory predicts. Together, they trace the complete information lifecycle, from the firm's disclosure decision, through the pricing mechanism, to the ultimate capital allocation outcomes. The connections among these streams are direct and testable. Disclosure theory predicts that greater information provision reduces information asymmetry, a disclosure research question, which should lower the cost of capital, a cost of capital research question, which should be reflected in efficient price adjustment, a market efficiency question. When any link in this chain breaks, for example, when markets respond slowly to disclosure, PhD, or when better disclosure does not empirically reduce cost of capital, it generates a puzzle that motivates research at the intersection of streams. These streams also connect to the three pillars surveyed in the companion handout. Value relevance research implicitly assumes some degree of market efficiency. Accounting numbers can only be value relevant if the market processes them. Earnings management research provides a reason why disclosure may be uninformative. If managers strategically distort reported numbers, disclosure quality is undermined, the cost of capital benefits are attenuated, and market efficiency with respect to accounting information is reduced. For doctoral students, the most productive research opportunities often lie at these intersections. For example, examining whether the cost of capital benefits of disclosure are diminished when earnings management is prevalent, or testing whether specific types of disclosure reduce specific forms of market inefficiency. Understanding the full architecture of capital markets research enables researchers to identify gaps and propose studies that advance multiple streams simultaneously. For further reading, 7 survey papers are essential. Healy and Palapu, 2001, lay the foundation for disclosure theory, while Bayer et al., 2010, offer insights on integrated information economics. Luz and Wysocki, 2016, explore disclosure regulation, and Lambert et al., 2007, formalize the cost of capital framework. Kothari et al., 2006, connect analyst forecasts to asset pricing. Additionally, Fama, 1998, and Schwert, 2003, complete this scholarly selection, building a robust citation network to inspire future research.